Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps morning meeting. You are all very welcome. I am just going to quickly run through why is my screen not working now? Back now to start. Some of the little admin bits and pieces, and then we're going to get straight into it with our first presenter. As you heard, Samantha is waiting for us patiently in Melbourne. My name is Mark Robin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time this morning, a quick compliance and disclaimer slide. For anybody who is joining us for the first time, if you're wondering the types of companies that we have on here every week, they're generally capped under $300 million in revenue and approaching cash flow break even, or indeed already profitable. We don't tend to have companies from the resources or the biotechnology sector. So we have what I call industrial microcaps, which spans a whole range of other sectors, including technology, retail, financial services, industrial products, niche retailers. So yeah, anything outside those kind of other two sectors, we just call industrial microcaps for ease of use. The structure of this morning's webinar, we have two companies presenting over the next hour. Each company gets a 30-minute slot, which we roughly break down into 20 minutes of a presentation, 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate the questions when we get to Q&A. Please note the webinar is being recorded and it will be posted on the Coffee Microcaps YouTube channel tomorrow morning. So if you have to jump off early or you only get to listen into one of the presentations, you can catch the second one on the YouTube channel. You can follow Coffee Microcaps on Twitter, as I said, YouTube for the recording of this webinar, indeed all the other previous webinars that we've done, which is now totaling 40 odd. LinkedIn, and I also write a weekly paid subscription newsletter where I focus on one ASX microcap stock every week, and you can get that on the Substack newsletter platform. First up, I'm delighted to welcome Samantha Cheetham, CEO and MD of SDI Ltd. And then we have returning actually to give us an update, Elias, Hazouri, CEO and Executive Director of HiTech Group Australia. So without further ado, I'm going to stop sharing my screen and hand over to Samantha to start sharing hers.
Okay, good morning, everybody. Just one moment while I get it up on my screen. Apologies. Oh, there it is. Got it.
And yeah, just want to make it full screen, Samantha.
It is full screen. Can you all see this?
Yeah, I can see it now, Samantha. Okay. That looks perfect.
Perfect. All right, fantastic. Good morning, everybody. Thank you very much for joining me today. I've also got with me my CFO, Chief Operating Officer, John Silvero. So he will present the financials. But it's been a really interesting 12 months. Absolute incredible uncertainty with the pandemic taking hold globally. SDI sells to over 100 countries, and we are affected by many different governments and their policies on how to deal with the pandemic, and I'll talk more about that later. But for those of you that don't know SDI, we manufacture in Melbourne, Australia, fillings for teeth and tooth whitening products. And the fillings for teeth, we focus on white tooth-coloured fillings and all the accessories to go with those products. And then we also focus on tooth whitening, which is a very nice cosmetic treatment that dentists provide for patients. So as we moved through the financial year, we began to see many regions emerge with the from the harsh lockdowns, because initially it was a harsh lockdown everywhere, and dentists had to stop operating. But we came out pretty quickly after about July. So, regions started to open up, and we really each region was affecting every month SDI and how their governments treated dentistry. So here we are. We have been around for 50 years in 1972, so next year is our 50th year. We do all our own research and development in Melbourne. We've got a lab full of scientists, up to PhDs and several PhDs and many specialist scientists focusing on dental materials and how to make them really hard, last long in the patient's teeth, and of course how to make beautiful white smiles quickly for the tooth whitening products. We're selling to over 100 countries. We've got offices in, of course, Melbourne. We've got one in Brazil, Sao Paulo, in Europe, in Cologne, Germany, and in North America, in Chicago, in the US. So we'll go through the highlights, the product categories, the geographies of where we sell to, how we did financially, and what our strategy is. So just in a summary, we have had a record year in terms of net profit after tax and sales. So the net profit was up 111% to 8.9 million and was ahead of our guidance, which was the range of 7.5 to 8.5 million in May this year. Our sales were 81.6 million, and they were up 21.2% on the prior year, driven by strong sales in the key product categories, the successful new product releases, and the gradual normalising of most dental markets due to the pandemic. The operating expenses increased by 1.2% in the year due to very careful operating expense management. And I'll spend some time talking about the product performance on the next slide, but the demand catch-up I spoke about and the impact of the new product releases was evident with the whitening and the aesthetic categories, up 55.3% and 27.2% respectively in local currency. And they're, as I said, two of our key categories that we focus on. In terms of our long-term strategy, that's where we want to go, just focusing on those categories. And then, of course, the most important thing is the dividend. The dividend is up 230% on the prior year, and the payout ratio is 41%. The fully franked dividend of 1.65 cents per share. So into the product categories. So as I mentioned, the category highlight for the year was the whitening category. It was our strongest category for the period, and it was up 55% in local currency. We saw strong momentum in the sales, supported by the release of the new Polar Light and Polar Rapid products. You'll see, I think, a photo of the Polar Light a bit further along. And we also rebranded our whole Polar range. Another highlight, even though it's one of our smaller categories, was the equipment, and that was up 31.1% in the local currency. And this is just the ongoing success of our radii curing lights. The aesthetic products, though, they're the tooth-coloured fillings and all the accessories that go with them. They also rebounded in the second half with the growth of 27.2%. And that was really assisted by the easing of restrictions on the dental markets. And in markets where the restrictions were progressively eased, Australia, North America, and parts of Europe, the growth was very, very strong. And then the amalgam category. The amalgam is how SDI started. It's the silver fillings in your mouth. The amalgam sales were actually up in local currencies by 3.8%, with the North American market offsetting the declines in the other regions. And then the sales by business unit. This is where we are invoicing from. The sales by business unit were consistent with the gradual easing of the government restrictions, seeing a return to normal operating conditions in many markets. The European sales were up nearly 40% in local currency for the year, driven by the strong demand in its key markets and assisted by the UK, which is one of our larger markets in Europe, where conditions rapidly improved in the second half of the year. Our Australian sales unit, which also captures the Australian direct export markets, was up 9.6%, with the domestic sales up an impressive 44.6%. However, this was offset by the direct export markets, which were down 3.3% over the year, with many of these regions yet to return to normal operating conditions. The Brazilian sales decreased by 0.2% in Australian dollars, and when we adjusted for currency movement, sales increased by 33.4%, reflecting the significantly weaker Brazilian real. As previously we've indicated before, we have reviewed the Brazilian operations, and the restructure is almost complete. And then this slide is probably one of my favorites because it really explains SDI. This is where we actually ship our products to, and not where we're always invoicing. So the key regions of North America, Asia Pacific and Europe performed well. And these performances reflect the return to normal operating conditions with the gradual easing of the government restrictions, but also the successful release of the new products. The variations in the regional performance is a function of the different approaches by the governments of these regions on the restrictions imposed and the gradual lifting of some of the restrictions on others. The performance also highlights the demand catch-up with dentists in many of our key regions going to normal operations. And then on to the financial performance, I'll pass over to John Cliviero.
Thanks, Sam. I don't know if you've got the presentation, but it's on slide number 11, which is in front of us. As Sam mentioned, sales were up 21.2%. And this underpinned strong demand in key regions with gradual easing of restrictions and successful new product launches. On the gross product margin, the positive mix effect during the year from strong growth in the higher margin whitening and aesthetic products was offset by regional factors and the increase in freight and production costs driven by the global logistic turmoil. I think everybody knows it. It's read about that. It's pretty difficult at the moment if you're exporting from Australia. But reflective of this, when adjusted for these movements, the gross product margin increased by 1.8% compared to last year. However, in Australian dollars, the gross margin declined 3.2% to 61.6 compared to 64.8 for the corresponding period last year. Total operating expenses in Australian dollars increased by 1.2% when compared to the previous year. After adjusting for currency movements and government assistance programs, underlying operating expenses increased by 8.8% compared to 2020 year. However, when comparing to a more normalised year, which is 2019, our operating expenses were up 1.4%. Finally, both EBITDA and net profit after tax was up strongly to record levels as we return to growth in the financial year. Now the balance sheet. The company's net cash position increased by 5.9 million to 10.6 million for the 12 months. The remaining debt of 1.5 million was paid down, and we don't have any debt at the moment. There was further investment in plant and equipment of 2.3 million and product development expenditure of 1.2 million. Further, we actively increased inventories by $900,000 to mitigate the continual global freighting delays. Finally, the company has unused bank facilities of $10 million. Turning to the cash flow. Okay. The increase in cash was driven by the strong operating performance of the business over the period, underpinned by the return of strong trading conditions. We received 3.9 million in government subsidies or government grants, if you like, not grants, sorry, assistance programs. In the 12 months, 1.9 million was allocated to operating expenses and 2 million to the manufacturing department to supplement the company's commitment to keep its global employees employed, while the group recovered from the reduced demand caused by the pandemic. Payment of dividends reflected the strong net cash position and the board's commitment to shareholders. I will now hand back to Sam to run through the strategy and the outlook.
Thanks, John. So the company's strategic priorities remain focused on 4 things. Number 1, the product categories of aesthetics and whitening, as I said before. Further manufacturing efficiencies and driving sales and marketing teams. The ongoing investment in research and development, which we're very, very passionate about. And the company's amalgam replacement product, which is on schedule for release in 2023. And as I have mentioned prior to this call, if anyone else has been following SDI, we've undertaken a very comprehensive review of our footprint, looking to drive efficiencies and to manage future growth, and expect, and we will expect to provide more information on this in the coming period. And so the outlook. The outlook has been very, it looks very, very positive, but I can certainly say that there's, in this particular time right now, in this managing a global business, there are many uncertainties, and SDI is no different. I'm encouraged by the strong rebound in our key markets and see genuine momentum in our business, underpinned by the opening of markets and new product releases. In the near term, the challenges we face are with the increased cost and delays of freight, the potential for further lockdowns, and the slow opening of the remaining regions we operate in. And on balance, we expect another year of growth and look forward to the return of normal operating conditions in most key markets. And thank you. I think that's it. Thank you, Mark and Martin, sorry. And I think if anyone's got any questions, I'll now unshare the screen.
Sam, you can leave it on the, I don't know if you've got an outlook, or sorry,
yeah,
a questions one, you can maybe leave that up for the time being. I might just kick off the questions while we're waiting for one or two to come in from the audience. Amalgam sales, you know, for somebody who's followed SDI for a while, it was a surprise to see them up, you know, given that they've been, you know, coming down over the last 4 or 5 years. Is that solely, do you think, pure catch up in, you know, Brazil and the US, where I know it's still a fairly good selling product for you guys, or is it, you know, some of these customers who might go for, you know, a higher price product, you know, trading down, or a mixture of both?
Yes, look, it has been, I think there is a bit of everything there. We have had strong sales in our North American market. It's always been a strong amalgam market. And of course, in some individual countries right throughout the world, the market has been strong, and then others it's declined. But overall, it was, as I think it was a 3% increase. It's generally, I think, more than there's a few changes in the market that we're just taking opportunities and getting a bit of market share. So it's not going to be like that forever, but it seems quite positive at the moment.
Okay, so those big declines that we've seen in kind of previous halves and years, should we expect to see that going forward, or should it start to more kind of taper out now on the run into 2023?
Yes, look, you know, probably single digit declines. It's really tough to tell at the moment. You know, as all the export markets open up, like the Middle East, South American markets, where they're particularly strong in amalgam, they could start their government tenders again. So it's a bit tough to to really predict, but it's, I would say, single digits.
Okay.
In terms of decline.
And then I mean, the balance sheet is looking in great shape now after you paid down the 1.5 million, I think it was in the first half that happened, and the strong cash conversion. In terms of moving forward, you touched on it, I think, in the outlook. You know, maybe, you know, is the board considering, you know, capital management, or are they keeping, you know, this, you know, cash on balance sheet for the next, you know, little while until, you know, we see where COVID-19 leaves us, you know, in 2022, or is, you know, acquisitions for niche products from, you know, kind of smaller dental manufacturers on the cards?
Well, I mean, we're certainly always open to all of that. We really do want to invest in the facilities and our sales and marketing and research and development teams, because that's where our growths are. So, you know, it's there waiting for those opportunities. I think it's you know, it is very still uncertain times.
Okay, great. And then with the if I can just touch on the new products that you know, are coming through, is there any kind of, you know, big blockbuster ones we should be watching out for over the next 12 months, you know, whether it be in the equipment side or the whitening side?
In terms of blockbuster, that, you know, is going to change, you know, the company right away. No, we don't have any of those coming. We generally, I mean, like in the last, just whilst the pandemic's been on, we've actually released 4 products, which is pretty impressive. Whilst you know, the whole team's you know, to get these products out, there's a huge amount of work. The whitening products, the Polar Light and the Polar Rapid products, are really starting to contribute to the whitening sales. You can see with the double-digit increase we got with them. In the next 12 months, we've got some more white fillings coming out, but they are a gradual increase, and sort of, you know, they take 2-3 years to really get going. We've got the amalgam replacement coming out in 2023, and that's looking very positive. It's you know, to me, that's a bit too far away at the moment. So
we've got one here now from the audience, following on from Mark. Could cash on the balance sheet be needed for any green site acquisition for a new manufacturing facility anywhere, rather than doing everything out of Melbourne?
Yes, well, we certainly could use that. We're looking at our footprint at the moment. We're spending a lot of time looking at that, looking to see what we need. And yes, that could absolutely be used for some of that, to invest into a greenfield site, which we've mentioned in other releases before.
Another question, this is actually on the products themselves. As you've gone through, do you design and manufacture the packaging? Where do you get the machines to do this? Are these barriers to entry for competitors?
Yes, in fact, you can see the picture on the screen right now. The purple and blue, they're capsules. They're actually single fillings. So there's sort of 2 types of packaging. So these are delivery systems, and inside those little capsules are powders and liquids that the dentist mixes up and quickly puts into the patient's tooth. We all know we don't like going to the dentist. It's usually painful. The dentist knows this, and they have to do it quick and easy. So this type of packaging is extremely important, and it's one of our key strengths. We even package products for our competitors. They send it from Germany and we ship it back to Germany. So in our capsules. So very, very important. It's absolutely a barrier to entry. And one of the reasons why in this particular category we're looking at, which is the glass ionomers, there's only a few competitors in the market. There's really, I could say in the North American market, there's really only 4 competitors, and we're one of them. So really tricky to get these products right, because they also, in those capsules, have to last for 3 years in terms of once the product's manufactured to when it's finally used. So absolutely, it's a very important part.
And if I can just touch on sales and marketing, Sam, have you had to re-look at that? I'm guessing, the big, let's say, American dental conference probably hasn't happened for the last year or two. It might be happening this year. Maybe just how you're, being able to launch these products in such a restrictive time from, getting to conferences and trade shows and just, having, I guess, sales consultants having one-on-one time with dentists to kind of explain the benefits of the new products.
Sure. So during the pandemic, there was webinars everywhere. We had key dentists, key opinion leaders, important dentists in the industry, explaining, lecturing to from 20 to 5,000 dentists about products that we've got in their own webinars and why our products are good and why they should use our product. Our sales team, we're doing Zooms to dentists now, depending on the region, obviously not Melbourne, but the sales teams around the world in most of the regions are now able to see dentists. Their call rate isn't as high as it used to be, but it's getting there. Trade shows are starting to open up. And the dentist will also see them through that area, that means. So it was, in terms of the face-to-face, yes, a bit slow, but it's I don't think it's really affecting the sales right now. It's great because obviously it's less cost for us, but when the whole market opens up, they will expect us to be at trade shows and constantly at dentists.
Okay, great. Sam, we might leave it there because I know we're pushing up on the half hour. Thank you very much, and to John as well for joining us this morning. I know you were on another call just before you jumped on with us, so thank you very much for taking time out of your schedule to join us. And I do know we have Elias standing by in Sydney. Elias, if you want to start sharing your screen.
Thank you very much, Mark.
Thanks, Samantha.
Thank you.
Thanks, John. Elias, I can see your slides now. If you can just go to slide share mode.
Yep.
Just to get it into full screen.
Excellent. All right.
There we go.
Apologies for delay.
Perfect.
All right. Thanks very much for hanging on there for a minute. It's just an issue of the virtual desktop. Thanks for being here today, everybody. I'll go through HiTech from a point of view of those who may not know us very well, and then lead into some of the financials that we recently reported, and then, of course, open up for questions if you have any. So the HiTech Group, as it stands, is one of Australia's probably longest existing or longest established ICT contracting and consulting firms listed on the ASX. We've been around since about 1993. We have a strong presence in the government industry. So in the government sector, we supply many of our IT contractors to federal and state government organisations Australia-wide. We do believe that our recruitment and consulting systems that we have developed are quite unique in the industry. We have a system that we call HiBase, which is one of these proprietary developed systems that we have that allows us to do what we do very, very well. It encapsulates probably just over 50 years of expertise and knowledge in the group. It's an intelligent system that has been designed to allow us to very efficiently and quickly capture the information that our clients give us to facilitate their needs from a talent and systems point of view. We then utilize that data to access the best technologists in the Australian market, and then have them contracted out to our clients. We do have two sectors within our organization. One is the HiTech Personnel Group, which is providing the talent and contracting personnel to our clients. And we do not just IT, but we can provide a complete solution for finance, office admin, sales, and marketing people as well. And obviously, we've been doing that very, very effectively for a long time. In the private sector, we do a lot of permanent placements, but in the contracting market, we're predominantly talking about federal government clients. And then, of course, the other side of the business is the services business, where we provide consulting services for IT projects. Our expertise really is quite unique in the industry. If you look at the board and the composition of the board, it's 3 people, including myself. And between us, we have well over 50 years of industry expertise. So we're very much the experts in the industry, in the consulting and contracting industry, especially in the IT side of it. We have a very strong and established client base that we've had for several years. We're on predominantly all of the key government supply panels that allow us to place our contractors. So it's a very strong brand as it stands at the moment. And to be around as long as we have means that we've seen a lot of ups and downs in the industry. We've seen a lot of changes, but we've been at the forefront of those changes, providing the technologies required to ensure that many of these highly sensitive national projects, which affect just about everybody in Australia, are actually running on time and on schedule, and being facilitated by the best people globally. We have a very different focus to a lot of our competitors. We don't really just go for revenue growth's sake. We try and grow our top line, keeping in mind our bottom line. Very, very focused on bottom line profitability. So with that comes the focus on ensuring costs are controlled, and our operating cash flows are very, very strong. We continue to maintain that kind of philosophy in running our business. A lot of what we do is focused on winning lucrative statement of work type of business, where there's ICT projects that are very sensitive, especially in the government sector. And we make sure that we have these sorts of arrangements in place, because that gives us longevity for our revenue stream. And of course, when it comes to highly rare and specialized individuals that are required to deliver this type of work, we can charge a reasonable margin for that effort. We are very much entrenched alongside our clients to deliver these superior results. I mean, if you look at our history, which I'll get to, our financial history, which I'll get to soon, you'll see that you can only really do that if your clients believe that your service is invaluable. And so we do that. We understand what our clients' pain is, and we work very hard to address and alleviate that pain. We're always seeking to broaden our client service capability. Everything that we do is focused on being a true service-oriented organization, and whatever our clients want, we will deliver if and when we can. It's very much a partnership approach, but at the same time, we have to be maintaining some sort of flexibility. It's not a rigid process, it's an evolving process. And just as technology evolves, so does our service model. We have an ingrained culture of financial discipline within the broader management and the board. So everything that we do is really very strongly aligned with our shareholders and what their expectations are of us. And we've worked very hard to maintain that ongoing economies of scale within our operations, so that we're not expending costs unnecessarily. The technology we have within our process is encapsulated in a system, as I said earlier, known as HiBase. This is an intelligent, predictive tool that allows us to source talent very, very quickly and efficiently and accurately with the right skill sets. It's an enormous database that we've built up over many, many years, as you can imagine. When you've been in existence since 1993, you do develop quite a large repository of professionals within the IT space. We've got close to 380,000 candidates in there, and we can deploy those individuals for contract or permanent positions throughout the country. We are at the forefront of the digital transformation movement as it's taking place. We have been since 2016, when the government embarked on a very large program of work to transform the way that the community communicates with government and interacts with the government. It's a very large program of work known as the Digital Transformation Initiative. And that's managed by a central organization known as the Digital Transformation Agency. It acts as the central hub for expertise in that space. But of course, every single government department around the country utilizes that expertise, and we are a direct supplier to that organization and the other organizations that are utilizing these services. Of course, our services team is also at the forefront of delivering the service in a very sophisticated but seemingly simple way to the end user. We have a project delivery service that we deploy within our clients. It's a very customized service for our clients as and when they need it, and only as and when they need it. So the costs are very well regulated there. Of course, having the ability to deliver project services is a key growth factor for us in the coming years, but it can only really take place if you have the right technologists and right personnel, and that's where HiBase kicks in, and our candidate database, which allows us to find the perfect person or a group of people to deliver on those projects when they become due. And of course, as technology changes and as time moves on with the pandemic, now into well over 12 months since we first found out about it, about the issues, everybody's gone online. The world is moving more into a connected digital world. And, you have no choice, whether you're in the private sector or in the government sector. You need to be able to ensure that your services are delivered digitally. And so there is a significant push now to ensure that this transformation, this digital transformation, takes place sooner rather than later. And there's been significant funds poured into it, not just by the government again, but organizations that understand now that their workforce has to be managed remotely, and they have to be able to be productive remotely, whether they like it or not. And they need to have the right technology in place. And that in itself breeds the programs of work that we are seeing every day. Where does HiTech sit in relation to government supplies of IT contractors? This is a leaderboard which is published by the government every month, and it shows the key top 10 ranking suppliers. Now, I have to tell you, this comes from a group of over 3,300 suppliers. So if you look at where HiTech sits, we're always about that in that position of the top three. So we're sitting at in June. That was whilst that says November, we're actually that footnote is in fact incorrect. It should be June. I apologize for that. I just noticed it. But that's we're sitting at about the 5th position there. We're generally always in that leader table. And from a size point of view, relative size point of view, we're one of the smaller organizations there. But you can see that we are very effective in what we do, and we generally have maintained that position for several years now. So we work very closely with a group of what we call blue chip federal government clients. In all the years that I've been doing this, well over 25 years, I really cannot say there is a better, more blue chip client than a federal government organization. These organizations are well funded, but they are essential. And so they continue to require our type of service. So when it comes to talent acquisition, in the IT space, there's no choice for them but to go out and get the best people to deliver on those projects. And we work very closely with the organisations to do this. They are very complex government environments. As you can imagine, you think of your largest banks and multiply them by 2 or 3 times. That's the kind of complexity that you have within these government organisations. And so it's very important work. And to be able to continually do this work with government, you have to have developed some very strong goodwill and rapport and a reputation. If you don't deliver, you get found out very, very quickly. Of course, that's not our problem. Our problem is to try and keep up with the demand more than anything else. So we have always maintained our reputation as a quality partner to government. And we always want to go in there and assist. However, it has to be financially viable for us to do that. At times, we've walked away from some business, and we'll continue to do that if we don't think that it's a profitable engagement for us. So as far as the government's concerned, there is a significant amount of money being redirected into digital transformation work. Of course, as the pandemic hit, whilst the government was already on its way to doing digital transformation work, it realized that there wasn't a sufficient amount of funding taking place. And so there's been billions of dollars poured into this sector now, and there is a strong push in government for all government agencies and departments to embark on a very expedient digital transformation initiative. And so that's what we're seeing right now. So the budgets in the future are quite significant. And so we should be able to benefit significantly from that budget push towards digital transformation. Our published results for the FY2021, obviously very impressive. We're very proud of these results, remarkable results given the conditions we are operating in a sector that, whilst you may think is easy to operate in, it really isn't. There are many organizations that have not survived the consequences of the pandemic, but given our entrenched and reliable relationships and partnerships that we have with our clients, we've been able to improve on every metric. You know, our operating revenues increased significantly by 26% on the previous corresponding period. GP has gone up another 16% on last year. NPAT, 9%. We've been able to produce an amazing net profit given the circumstances we were facing. And of course, EBITDA up 20%. These are very, very significant numbers in the environment that we're operating in. It's our 7th consecutive double-digit growth year for the group. So it's testament to the way that we've developed our operating model and our revenue model. You cannot produce these sorts of results year in, year out for this length of time if you don't have an enduring model. And obviously, one that we can tweak along the way, but that comes from the expertise that we have within the group. And we're very, very bottom line focused. So we're always ensuring that our processes are very, very efficient. A graphical look at the returns that shareholders have experienced over the years. You can see that the growth rates are, again, quite significant, whether it's revenue, EBITDA, NPAT. They are just numbers that are really outstanding in the industry. You won't see these sorts of numbers across our industry in general. And that's because we don't just go for revenue. As I said, you know, we're up at 42 mil revenue for the 21 year. We probably could have been at 60 million, but it would have hurt our margins. It would have hurt our returns. It's not the kind of focus that we have at the moment. Perhaps in years to come, we may go down that path, but for now, we're really very strongly focused on bottom line. And of course, our dividends are quite significant. We're not going to not give back to our shareholders, our loyal shareholders who've been around with us for some time, and of course our new shareholders who are investing in us. So the dividend stream is quite healthy, and that's backed by our retained earnings and our cash position, which is also quite significant. So the year ahead of us is looking quite good. We believe that with all the activity that's taking place, the demand, the really healthy demand that we have for our service is going to underpin our recurring revenue streams, which we have in place. We are offering our services in an enhanced manner to benefit every single organisation we deal with. And effectively, what we want to be doing is really benefiting the Australian community. There are services we provide that we know have a direct correlation to improve services for Australians. And that gives us a real motivation to continue to go down that path and ensure that we are providing an efficient service. Of course, we're going to benefit. There's going to be more work for us, especially in the high margin consulting and services space when it comes to technology such as cloud and cybersecurity. And of course, as the world evolves and we understand more about being connected digitally, we have to understand that there are some significant cybersecurity risks involved. You may have heard in the press, the government's always talking about the cybersecurity threat it has, the attacks it's had, or potential attacks on their systems. We're at the forefront of finding those technologists that can protect those systems. And of course, as our database is sitting there and our talent database continues to grow, we have the right people available. So as demand ramps up, and we're seeing it ramping up, then we're going to be well positioned to ensure that we can take advantage of that demand. On the other side of our growth strategy, it's not just organic. We are looking for acquisitions. We're on the hunt for the right organizations, ones that give us some scale, further scale, and of course, EPS accretion. So it'll allow us to have multiple benefits if we acquire the right organization. And of course, if we are trying to utilize our key asset, which is our database and our know-how, then we can also drive growth within the acquired organization. And that will just deliver further returns for our shareholders. But our M&A growth strategy is well and truly underway. Whilst we have the right intentions, it doesn't always work out, and we need to be sure that we're de-risking the acquisition as much as possible, and bringing in organizations into our group that are going to have a very long-term benefit for all shareholders. That's basically it. I'm open to any questions that you have. Please let me know, and happy to take it from there. Thanks very much, Mark.
Thanks for that. I might just kick off the questions, just to maybe go back onto the acquisitions. I know you've talked about before when you presented to us the last time, you'd like to, while the federal government is obviously a great client to have and has served you well, you are trying to diversify that base a bit, into state government and ideally into the, the corporate private sector. So is that something you're looking for in the acquisitions as well, is to try and diversify the customer base a small bit? So, look for somebody who's, well entrenched with, WA government, or, somebody who's very strong in a particular corporate sector, be it financial services, or be it, consulting to the mining industry, for example.
Yeah, absolutely, Mark. I mean, our key metric is that the organization is established, it's well run, and it's going to be EPS accretive for us. What sector it's in, we'd like to think that it's in a relatively high margin sector. So whilst it may be in government, it doesn't have to be. And if it means that it's a services organization, for example, which we don't do too much of, then it's a very complementary acquisition for us. And then that gives us access to private clients, perhaps nationwide in different industries. Or as you said, it could be in different governments, different state governments. Absolutely open to that. Private clients are going to be the next growth sector. You know, when I spoke about the digital transformation initiatives that are taking place, they're happening in the private and in the public sector. But you know, if you don't have the right technologists to enable this transformation, you can't do much. And so, of course, we're targeting the private sector. And if that can happen via an acquisition, fantastic. I mean, we're open to it. And that's what we want to see happening. We don't think that there's any real limitation as to who we acquire, other than the fact that they have to be, you know, a reasonably well-established business with a, you know, a profitable outcome for us. And of course, with our expertise, our connections, we can enable further growth for those businesses that we do acquire.
And another question, obviously the borders have been closed and looks like they're going to be closed for the best part of 2 years. How is that affecting, you know, getting talent into Australia, which is virtually none, I suspect, but for the, you know, for the contracting side of your business, is that pushing up labor rates? And, you know, what does that do for margins when labor rates are going up simply because, you know, there is just such a rush for skills, you know, right across the economy?
Yeah, no, it's a good question. I mean, you think initially, oh yeah, you know, it's going to be a shortage, but one of the things that we're faced with here in Australia when it comes to federal government space is you can't really have non-Australian citizens working. In fact, a lot of them have to have security clearances. So these are not just specialized technologists, but they have to be vetted by the Australian government as security cleared. So what it does is it allows us to ensure that we utilize all of our people nationwide that are sitting on our database to be able to, you know, place them in these lucrative contracting roles. So in a way, it's a great thing because we've always been pushing, you know, buy Australian. We want our Australian talent market to be fully employed as much as possible. You know, we don't want to be competing with overseas candidates that take Australian jobs and things like that. So for us, it's fantastic because what it does is it allows us to use our tools to find these people wherever they may be and deploy them into these critical roles. Now, yes, with demand, there does come a push, an increase of pay rate demands. That's fine, but then the clients have to pay more, and there's a flow-on effect. So in that way, we are very you know, keeping a close eye on things, but we maintain those margins as we go forward. There is a bit of a delay. You know, the clients don't always respond as quickly as you want them to in relation to increasing the expectation on billable rates, because they always want to pay as little as possible, of course. But we educate them and we show them the consequences of not paying the right rates. And of course, that helps us maintain or improve our margin at times.
And then one final question. The overall split between, you know, perm recruitment and contracting, do you have a specific target that you like to keep that in the business, or are you happy for it to wax and wane, you know, from year to year?
We want it to be predominantly contracting always. We don't have set figures, but we really need to have a recurring revenue stream, and that means you have to be heavily skewed towards contracting. Permanent's very profitable, and we enjoy very much, you know, placing permanent people in roles, but they can get quite lumpy. So we're skewed very heavily towards contracting revenue, as it gives us that annuity income.
Okay, so the perm revenue is kind of like the cherry on the top.
Spot on. Yeah, we definitely look for it, and that's where our private client database kicks in, and we end up placing people in those roles, in those permanent roles with our private clients. So we haven't aggressively targeted that recently, but I think as we deliver more and more technologists to enable some of these projects, the next phase will be to keep the lights on, and so our clients will require permanent staff to do that, and we see that happening maybe over the next 12 to 18 months.
Okay, great. I think we'll leave it there. We're just pushing up on time right now, and I know the opening match is about to happen. So,
alrighty.
Elias, thank you so much for that. As I said, the recording will be up on the Coffee Microcaps YouTube channel tomorrow morning, and I wish everybody a good rest of their Thursday.
Thanks, Mark. It's a pleasure.
Cheers. Thank
Bye,
you.
everybody.
Bye.